Now, the deep sell-off in financial markets, it points to recession risk. Is a recession imminent? While market moves suggest so, the US economy's resilience in the face of vibe-cession or economic slowdown fears over the last 2 years tell us otherwise. Take a look at our next report for more on this.
Markets are telling us that a recession is almost imminent, but the US Federal Reserve is not perturbed by massive negative bets and moves in the financial markets. The Fed's role under the cloud of vibe-cession becomes more important for investors. So far, the Fed's approach is to wait and see how the hard data plays out. While the market meltdown suggests the Fed's rate cut trigger is not coming anytime soon, the central bank's communication and action amid escalating trade wars led by US President Donald Trump becomes extremely important. The sudden emergence of the term vibe-cession has sparked much concern in the United States, which is unsurprising given the widespread belief that a real recession is imminent. The risks associated with Trump's massive policy changes and his growing trade war are reasons why many in risk markets share those fears. However, it appears that the US economy is still holding its own. In 2023, there was a vibe-cession, a time of more pessimistic feeling that hardly slowed the rate of economic growth. Economic slowdowns aren't so important to the Fed. However, inflationary cycles bring Fed rate hikes and recessions in the economic waves. The greatest danger is that even in a stagflationary situation, it is the fight against inflation which may cause rate hikes and, in turn, a recession. And the market's vibe-cession is only important for the US Central Bank if it causes a real recession. What we learned in 2023 of using surveys of customer sentiment and other forms of soft data to forecast the economic cycle is not reliable. Just over a week ago, a highly watched University of Michigan survey revealed that households' long-term inflation expectations reached their highest point since 1993. Last week, in response to the global economic impact of Trump's tariffs, the Fed raised its inflation projection and lowered its growth forecast. Considering the recent background, it's important to examine concrete data for signs of slowing growth amid stagflation fears. There is a higher potential for negative outcomes from Trump's trade wars. For the Fed, data comes from a comparable event. 3 years ago characterized vibe-cessions as a negative economic indicator. In retrospect, the current Fed's thought process that vibe-cessions aren't real recessions is a more appropriate approach. The bigger fear for the Fed is still inflation and not growth hit from Trump's economic broadsides. Rate cuts is what markets need for the next leg up. But if that easing comes under extreme economic pressure, the opposite may be true. More importantly, the bigger risk is if the Fed does a U-turn to rate hikes to counter an inflation surge. Business Bureau, WION World is One.
For latest news, download the WION app and subscribe to our YouTube channel.